Hello everyone, this is JY. I am a tax preparer in Community CPA, and today I will introduce the new changes for 2022 tax returns and tax planning to save the tax liabilities. And today's topic will be mainly focused on the 1040, the personal taxes, and also if I have some more time, I will introduce about the business taxes. So first of all, in 2022, the standard deduction increased because of the inflation. That the IRS increased the standard deduction up to $12,950 per single, and for the merit filing jointly, they increased to $25,900. And the merit filing separately, same as single. Head of household, who has the qualified child, the standard deduction would be $19,400. And qualifying widow, the same as the merit filing jointly. Qualifying widow means that the person who lost her or his spouse, and then qualified widow can maintain the tax status as a merit filing jointly for the 2 years after the spouse passed away. So the tax brackets for single filers and married couples filing jointly is the bracket 10%, 12%, 22%, and 24%. With taxable incomes. So the many people confused, they are paying just one tax rate, but that is the several tax rates depending on the income levels. So I'll give some examples for that. So for example, if you are single and earn $70,000 for annual salary, and if you apply the standard deduction, that your tax is, we can calculate, let me calculate your tax rates. So this is the total tax you are paying, $16,336, which is, no, that is, sorry. And this is the $8,168 for the single taxpayer, which is the effective tax rate is 11% instead of 22%. 22% is marginal tax rate. So if you earn $70,000, your standard deduction is $12,950. And the taxable income would be $57,050. So the first $10,275, you pay 10% of that amount. So the tax will be $1,028. And the second bracket, which is up between $10,275 to $31,500. That is the, I will show you one more time the bracket. So between the $10,276 to $41,755, you are paying 12%. So that amount is $31,500. So if you pay 12%, the amount would be $3,780. And the balance remaining, the amount would be $15,275. And you are paying 22% of that amount. So the tax for that, the range is $3,361. So your total tax would be $8,168. And if we look the merit filing jointly, let's assume the income is $140,000, and the standard deduction increased to $25,900. So your taxable income simply $114,100. And then tax rate for the first $20,550 would be $2,000.55. And then the second, the range, 12% is $63,000. So the tax is 12% of 63,000 would be 7,560. And then remaining amount will be imposed at 22%. And the tax would be $6,721. This is 22% of 30,550. So the total is $16,336, which is the effective tax rate would be 11.67%. So that is exactly the same as the $70,000 of per single taxpayer, or double the income, but tax rate remain the same. And this is the tax bracket for the married couples filing separately and head of a household. The married filing separately, same bracket with single. And then this is the head of household. I'll give you some examples. So the married filing separately, same as single. So I will show the example for head of a household. Let's assume the same level of income, and the standard deduction increased to $19,400. So the taxable income would be $50,600. So the first $10,475, they will charge 10%. So the tax would be $1,028. And then the second range, they charge 12% of $31,500. And then the tax would be $3,780. And then the remaining balance would be $8,825. And then the tax rate is 22%. So the result would be $1,942. So the head of a household paying, if head of a household salary would, if the salary is $70,000, and the tax would be $6,749, which is the effective tax rate is 9.64%. And then after the federal taxes, you are paying the state taxes. So for the state taxes has a similar concept, but that is they calculated that amount is added to the tax rates. So it is a little bit complicated. So I will show you the examples to make you understand the tables. So single marital filing separately on combined return. Let's assume the single filer, single taxpayer on $70,000. So federal tax rate was 11.67%. But the state income tax is based on the regulation. The table shows 2,654.25 plus that amount is the balance amount. So if you look at this one, $70,000, the over 52,290, but not over 78,435. So if the single taxpayer salary belong to this range, then the taxpayer should use $2,654.25 plus 7.44% multiple over the excess over $52,290. So if we adopt this formula, so we use that amount from the table, and then we get that amount, the balance amount, $15,500, and multiple 7.44 become $3,807. So anyway, the effective tax rate would be 5.44%. So as a total, the federal, if you earn $70K, then you pay 11.67% to federal and 5.44% to state. And this is the FICA tax. FICA tax means that the Social Security tax and Medicare taxes. And if we add up all three taxes, it will be 24.76%. So if your income is 70K, you roughly pay 25% to taxes, including the federal, state, and then Social Security and Medicare taxes. And similar to the married filing jointly. So married filing jointly, head of household, the federal tax rate is same. But the income is, I assume the married filing jointly income for $140,000. The state tax rate increased just a little bit, but in the case that it is assumed that the $140,000 earned by just one spouse, but if we allocate the $140,000, half of the taxpayer and half of the spouse, the state tax rate will be same as the married filing separately, 5.44%. So, and this is the formula for if the income increased $140,000, you should add $4,599 plus the remaining amounts will be multiplied by 8.53%. So that is the introduction of the 2022 tax brackets and standard deduction. And then now I will show you how to reduce or optimize the tax liabilities. For the federal tax credits, we have the 6 types of the credits. One is the first one is you can get the child tax credit if you have a child. You are claiming child that under age 17, you can claim $2,000 per child. It was in 2021 tax return, it was increased to $3,000 because of the COVID, but 2022 tax returns back to normal, and then $2,000 you can claim. And the second credit you can claim would be child and dependent care credits. Is if you and your spouse work at the same time, you can claim child and dependent care credit. For example, if you spend money for the daycare, and if your spouse also works, and then you can claim the expenses up to $3,000 per child, maximum $6,000. So even though you have 3 kids, you can claim max $3,000, and the credit would be 20 to 35% based on your income. And then third credit would be credit for other dependents. If you claim the dependents who is older than 17 years, then you can claim as other dependent. Your kids who is older than 17 but stay with you because of full-time students, or your parents who is not who shouldn't be dependent, then you can claim as dependent, and then you can claim $500 per dependence as a credit. And also there is also education expense credits. The first one is lifetime learning credits. You can claim 20% of maximum $10,000, which is $2,000. That is okay, let me explain the American Opportunity Tax Credit, and then I will explain a little bit more of lifetime learning credits. American Opportunity Tax Credits is the credits who can claim the high-level educations, which is the undergraduate students can claim the tuitions, the maximum $2,500. So they can claim the $2,000, 100% for the first $2,000, and then 25% over the $2,000. So if you spend $4,000 for your kids, the education fee for the college, you can claim first the $2,000, exactly the same amount. And if you spend more than $2,000, then I said $4,000. So the excess amount, $2,000, would be 25%. So 25% of $2,000 would be $500. So maximum would be $2,500. So even though you spend $5,000 for your kids for the tuition, still you can claim max $2,500 credit. But after your kids graduate undergraduate school and go to the graduate school, you can still claim the tuition fee, 20% of maximum $10,000. So that is the low limit of the time. And then even though how many years your kids attend the graduate school, and you can claim that the $2,000 without the time, the limitation. And the last one is the earned income credit. That is the credit designed for the low income, the taxpayers. For example, married filing jointly with 2 children and can claim the earned income credit if their adjusted gross income is less than $55,000. And then if the income is more than $55,000, there would be no earned income credit. But if the adjusted gross income decreasing, then the earned income credit will be increased, maximum up to $6,164. And then there is Iowa state tax credit, and many people are missing this tax credit. But Iowa state allowed claim the tax credit for the education purpose if you pay the tuition for the private schools or textbook, the school supplies, including the clothes for use for the school activities. You can claim still 25% of the total expenses, maximum $500. So if you spend the $2,000 for kids, you can claim maximum $500 for state tax returns. And so here I'd like to introduce some deductions with we say this is above line deduction. This is not a credit, but this is also not the itemized deduction. You can deduct these expenses from your income. So, but it is a little bit confused compared to the itemized deduction. For example, the medical expenses, you couldn't deduct the medical expenses against your ordinary income, because the medical expenses should be combined with the mortgage interest expenses and real estate taxes, or those kinds of the itemized expenses can be combined and compared to the standard deduction, and then you can choose which one is the beneficial for exemption. But those, for example, individual retirement account contributions wouldn't be wouldn't be combined to the itemized deduction, but it is deducted directly from your salary. So we usually say above line deduction. So if you contribute $6,000 to individual retirement account, you can deduct directly from $6,000. You can directly deduct $6,000 from your salary. And if we look this amount, you can save. Let's go back to the bracket, tax bracket. So if you are single, the taxpayer, and if you earn $70,000 per year, and even though your effective tax rate is 11.67%, but your marginal tax rate is 22%. So if you reduce your salary from 70,000 to 64,000, you can reduce $6,000 here, this range. So you can simply, if you contribute $6,000 to individual retirement account, you are not reducing the tax liability 11%, but you can reduce your tax liability 22% of $6,000. Simply more than $1,200 you can reduce. So the marginal tax rate would be important to figure out how much you can save if you contribute to IRA or all other deductions. So the most famous deduction would be the individual retirement account. Everybody can open that account, even though you have the other pension plans, and that is per person. And if you married filing jointly, you can contribute the IRA, and your spouse also can contribute another $6,000 IRA. And if your age is 50 or older, there is an additional $1,000 of catch-up. So the maximum would be $7,000 you can contribute. And also the 401k, everybody knows about that. That the maximum the contribution for 401k would be $20,500. And then also a company can contribute match $20,500 and more if it is needed. But so the maximum contribution would be $61K, but there is no discrimination rules. So if the company matched the 401K, it should be matched to every employees. So it is useful for the business owner employees who or only two or husband, wife, or only shareholder employee use that kind of strategies, maximize the 401k. And the third one is health saving accounts, that is used for the high deductible health insurance holders. The single if you are a single taxpayer, you can contribute to $3,650. And if you have the family insurance, and you can contribute $7,300. So the high deductible health insurance plan means that the deductible amount for 2020, that if you the maximum deductible is more than $1,400, you are eligible to contribute to the health saving accounts. And for the family, if the deductible is more than $2,800, you are also eligible to contribute maximum $7,300 for HSA, the health saving accounts. So that is the, for example, that is the normal, the deduction, the individual 3,000, family 6,000. That means that you can eligible to contribute the maximum if you are insurance holder for the family. You are eligible to contribute $7,300 to health saving accounts. And this is very beneficial, the program for the taxpayers. And because you don't need, this is pre-tax contribution. So that if you the insurance holder for the family, and then if you contribute $7,300, you can deduct that amount from your salary. So that amount would be the tax exempted. And if you get distribution from that account, then also that is the tax free, as long as you claim using with the medical expenses. And then also you can invest that fund to the mutual fund, so you can get a capital gain, but still that is not taxable as long as you claim with the medical expenses. And not like the other account plans, you can roll over that amounts until you get distribution. So there is no time limit. And if you reach 65 years old, you can get the distribution without penalty, even though you pay the distribution as ordinary income. But still, you can get paid after you're 65 years old, like traditional the IRA. But if you still have the medical expenses, you don't need to pay the income taxes for the distributions for the medical expenses. So some people from, I saw some clients who contributed to these health saving accounts, but they just invested that amounts to the mutual fund, and they do not claim even though they have the medical expenses. Instead, they accumulated the medical bills, and they are taking a pic. They took the pictures of the invoices, and they accumulated. They saved that the invoices to the cloud, and then if they need money, and they actually paid from their pocket, and if they need money, they just take out. They look the medical bills and they claim the amount they need using the saved the medical bills. So that is very convenient, the tools for your retirements, as well as the emergency. If you need money urgently, you can use that the HSA. So I strongly recommend everybody, if you have certain amount of money you can save, that I strongly suggest you to save the HSA account. And there is another deduction for state that is 5 to 9 plan. And that is the only for state deduction. So, but the maximum is if you have the two kids, taxpayer and spouse equally contribute $3,522 for each kids. So if you want to maximize the contribution for the education fund, the maximum would be $14,088. And that is the deduction for the state. So if you want to deduct the state taxes, that is the useful tool as well. And then also this fund will be invested to the mutual fund. And if you get distribution for the educational purpose, there is no income taxes for the contributions. But they will charge the taxes for the capital gains. And so that is the brief, the review for the personal taxes. And then for the business taxes, we have the 5 types of the tax entities. First one is sole proprietorship, which will be filed under the personal taxes 1040. And the second one is the partnership. If you have 2 or more people established the business, you can set up a partnership which is fit for the real estate rental businesses. And then you can also elect the S corporation and C corporation. So there is many benefits for the S corporation, which is that you can reduce self-employment taxes. I will show you some example. How can you reduce the tax liabilities when you elect S corporation compared to the sole proprietorship? So, for example, let's assume that this is if you open your business as a Schedule C using the Social Security number or sole single member LLC as a sole proprietorship, same words. And if we say that the revenue is $300,000 and the expenses $200,000, and let's say the income, net profit, taxable, the net profit is $100,000. If you file this income under 1040 as a Schedule C, the single member LLC business or single sole proprietorship business, then you should, and then let's assume there is no other incomes, only the business income, $100,000. Then you should pay the self-employment tax for that. The self-employment tax is 15.2% of the income, but that is you can say the FICA tax, that is the Social Security and Medicare taxes. If you get paycheck from the company, you pay 7.6% to the Social Security and Medicare taxes, and half of the Social Security and Medicare taxes will be paid by the company, which is 7.6%. So the total is the 15.2%. But if you run your own business, you are employee, but at the same time you are employer, so you're supposed to pay the total amount of the Social Security and Medicare taxes, which is 15.2%. So you're supposed to pay the 15.2% of the $100,000, but that amount is a little bit decreased because they deduct the qualified business income deduction. So roughly you pay $14,129 as a self-employment tax, and half of the amount would be adjusted from the income. So your adjusted gross income would be $92,935. And then as a single taxpayer, you can deduct $12,550. And then this is qualified business income deduction. That is the beneficial program. If your income is less than the $150,000 as a single taxpayer, you are eligible to deduct 20% of the income, the business income. But that is not the 20% of $100,000. There is several conditions we should compare what would be the qualified business income. In this case, the qualified business income is the standard deduction from the adjusted gross income. So the 20% of the qualified income would be $16,077. So the taxable income reached to $64,308. And if you calculate this amount, which is less than $70,000, I show you the example of $70,000, the tax rates. But if we put this amount to the formula, the federal income tax would be $9,900. But the self-employment tax would be $14,129, which is much higher than the federal income taxes. So the total federal tax would be $24,000. And then there is the Iowa income taxes. Same, we can adopt the same formula I explained previously. So the total taxes would be $30,243. This amount, including the federal income taxes, state income taxes, and the payroll taxes. Payroll taxes means the FICA tax. That means that the Social Security and the Medicare taxes. But if you if you elect the 1120 S corporation using the same concept, let's say that the total income $300,000 and the business expenses $200, same as the Schedule C business. But if you elect the S corporation, there is one condition compared to Schedule C. The owner employee should get reasonable salaries from the company, which means that if the owner employee get the salary from the company, he's supposed to pay the Social Security and Medicare taxes. So as long as the owner employee receives the reasonable salary from the company, the rest of the net profit wouldn't be waived, would be waived from the FICA taxes, the payroll taxes. So if we look at let's say that 30% of the net profit would be reasonable, the salary for the officer, then we can deduct $330,000 as the officer's salary. And then the 7.6% of the payroll taxes for $30,000 would be $2,280 as payroll expenses. And the normal business expenses was $200,000. So the income decreased $67,720. And then that income would be passed to personal tax returns. So the personal income, that is the salary received from the company, W-2 incomes, and then that income passed to the personal and as a Schedule C, and the total income would be $97,720, which is the compared to the $100,000 reduced payroll taxes. And then, but in the case, there is no adjustment for the self-employment tax. So adjusted gross income would be $97,720. And then we can adopt the standard deduction, same as the 1040, because that is 1040. So standard deduction is $12,550. And then the qualified business income deduction decreased because that is the 20% of this $67,000. So the qualified business income decreased a little bit. And then taxable income increased from 64K to 71K. And then in consequence, the federal income taxes increased to $11,500, but the FICA tax, that is the same as self-employment tax for the personal level, that is the decrease to $202,280, because you don't need to pay the self-employment tax for that portion, $67,720. So the federal tax decreased $13,786, which is more than 30% decreased. And then the state income taxes, similar, but they decreased a little bit. So in consequence, you decreased from 30K to 19K. So almost $11,000 you decreased the taxes. So there is no reason not to elect the 1120S corporation. If your income is more than $100,000, I strongly encourage you to change. And if you are still filing your businesses under 1040, I strongly recommend to switch the business tax entity from 1040 Schedule C to 1120S corporation. And so if you have any other questions, you can ask Catherine, and then I can give you some more detailed explanation. Thank you for watching, and that's all for today.
Thank you so much, JY. Thank you. If you have any questions for JY regarding the presentation, feel free to reach out directly to me, Catherine at communitycpa.com, and I am happy to connect you. Thank you, everybody.